welcome to another episode of the Wanderlust Wealth Show. Today is going to be a no fluff, no BS podcast episode because I am literally just giving you all of the information right now that you need in order to buy a property with less than 5% down. Okay. Like these are literally the 6 loan options, the 6 best loan options that you can use literally today. You can go to a loan officer and get pre-approved to buy a property for 5% down or less than that. Now, you're going to want to make sure to stay until the end. I'm 100% leaving the best one until last. I literally have 2 students who've just closed using this kind of a loan, and it's like insane. Everyone needs to know about this. Okay, truly one of the best things out there. Okay, but like I said, no fluff, no BS. We're just going to get right into it and give you all of the goods. So number 1, the first loan that you can use to house hack, to buy a property for less than 5% down is a conventional loan. Now, a conventional loan, you have to put anywhere from 3 to 5% down. If you're buying a single family home, only 3% is required. If you're buying a duplex, triplex, fourplex, up to a fourplex, so up to a property that has 4 units, then you can do 5% down. But conventional loans are honestly awesome. They're like the easiest loan to get, honestly. They do a lot less scrutiny than some of the other loan products. So if you can use it, go ahead and use a conventional loan to get that first or that second property. So let's say we're looking at like a $500,000 property, right? You're going to have to put 3% down or 5% down. So if let's say you were getting a $500,000 duplex, 5% down on that is $25,000. So that is how much you're going to have to put down in order to get a property. Or you could do 3% down, which would be $15,000 if it's a single family home. So remember, if you're house hacking and you buy something that's technically a single family, but it's got a basement and a main house and you separate them out, then you can only put 3% down to get that property, which is insane. A conventional loan is great because they have really good interest rates, and it's really going to be dependent on your credit score and the amount of debt that you carry. So the least amount of debt that you carry, the better your interest rate is going to be. And that's going to be across the board, okay? And like we were saying before, the nice thing about using a conventional loan is you can actually put 5% down on a multifamily. Now, with all of these loans, these are assuming that it is going to be your primary residence, right? Because this is all I talk about here on the podcast. This is what I teach all of my WWA students. You guys have heard me say it time and time again. And if it's your first time here, hear it now, okay? Easiest way to buy a property is to actually live in it, and you can rent other parts of it out to cover all of your mortgage and your expenses and decrease the amount of money that you're spending towards rent and things, right? So here's the thing. A lot of people get super stuck with the whole putting less than 20% down because everyone is terrified of what is known as PMI, private mortgage insurance. So if you put less than 20% down, you have to pay this private mortgage insurance that's rolled into your mortgage amount. The thing is, y'all, it's not that much. Like literally, my first duplex, I put 3.5% down on it, and I pay about $120 a month of PMI. It's not that bad. And if you use a conventional loan, it actually gets removed once you get to 20% equity. So once you hit that 20% equity on the property after a few years, that PMI falls off. So that's the nice thing about using a conventional loan. Now, the annoying thing about using a conventional loan is that you do have to have at least a 620 credit score minimum. I would say you can be in those upper 600s and those 700s, then you're crushing it. Anything above, honestly, like a 740 doesn't make that much of a difference, but either way, the better your credit score, the better chance you're going to have of being able to qualify for this kind of a loan. They also have stricter income requirements as well. So if you're not making a ton of money, you're really going to qualify for very little, right? So that's one of the struggles about using a conventional loan, but it is a great loan product. I would highly 100% recommend you look at that route if you can. Okay, now the next loan that we're going to look at, this is one of my favorites. This is what I actually used to get my first investment property, is an FHA loan. And we're going to go over 2 different kinds of FHA loans, basically. But FHA loans, this is from the Federal Housing Association. Also, if I forget any of the acronyms here, Don't sue me. Like, it just is what it is. I sometimes forget. It's okay. Okay. But an FHA loan, you can put as little as 3.5% down on a property up to a fourplex. So a single family duplex, triplex, or a fourplex, you can put as little as 3.5% down. That is exactly what I did with my first duplex. It was a $399,000 duplex. I put 3.5% down. That is about $15,000, right? Not much at all. Totally doable. And that is what you need. Well, plus closing costs. But that is really that's the bulk of what you need in order to buy a property for less than 5% down on an FHA loan. Is only 3.5%. Now, the positives about using an FHA loan is you only need a 580 credit score. Like, way easier to qualify than a conventional loan. And a cool thing is it can be used for multifamily, and they have a lot more flexible income requirements than with a conventional loan. However, the negatives is that MIP, they don't have PMI, which is private mortgage insurance. Instead, they have MIP, which is mortgage insurance premium. They're basically the exact same thing. For FHA loans, it does stay on for the entire life of the loan. Sometimes FHA loans may also have slightly higher interest rates than conventional loans, like 0.5% higher or something like that. And you can only have one FHA loan at a time unless the next property that you're buying is over 100 miles away. Then depending on which lender you speak to, and if you join like a program like WWA, we give you different lenders, you can actually qualify for another FHA loan, which is really cool. But so within FHA, you also have the FHA 203K loan. Now, the FHA 203K loan is if you need to do any renovations or additions to your property, you can actually roll in the costs of renovations and build outs into your loan. So let's say you're buying a $500,000 property. Now you want to do some renovations on it because it's not in like the best shape and you want to make it a little better. You can actually roll in the cost of that renovation. So let's say you want to do $20,000 worth of renovations. Now that $500,000 property will be considered a $520,000 property. So you only take 3.5%. You only have to put down 3.5% of that entire amount. So you don't have to come out of pocket an extra $20,000. Huge, like such a freaking game changer, right? Because if you're doing 3.5% of 520, I can't do math on the fly apparently, but that's like $18,000-ish that you're going to be out of pocket. But if you only did 3.5% down of the 500,000, you'd still be out about $18,000, but then you'd also be out the extra $20,000 for renovation. So that now brings you up to almost $40,000. I'd much rather be down in the $18,000 to $20,000 range, right, than the $40,000. So that's the cool thing about your FHA 203K loan. Now, great loan. However, it can be a pain in the butt, okay? The documentation that you have to go through, and you have to use a specific contractor to actually do the fixes in your property using an FHA 203K loan. So you have to submit all of the documentation for different parts of the renovation process to the FHA folks, which can be sometimes a pain in the butt, but so worth it because you're getting to essentially do all of your renovations for so much less. And then there's the FHA streamlined, which is renovations under $25,000. That goes a lot quicker. If you want to do more extensive renovations, you are able to do that. But once again, it's just a lot more paperwork and stuff like that. A little bit more of a headache, but still completely worth it. And it's such a great way to get started investing in real estate. Okay, so that was the second loan. So we went over conventional loan and FHA loan. Now, the third loan that I'm going to bring up is the USDA loan. Now, the USDA loan actually allows you to put 0% down. And all the loans that we're going to go over after this are all 0% down, which is freaking huge. Like the fact you can literally put $0 down on a property is insane.
Okay, y'all, do I have something exciting for you? Now, I just came out with a brand new free training on exactly how you can get started investing in real estate within the next 3 months. Because if you're someone who wants more freedom in your life, the ability to travel the world and do the things that you actually want to do in life, you're going to want to listen up. Trust me. Now, this training is freaking awesome. I literally go in and spill the tea on the number one strategy that is working right now, like literally today in today's market. And I go over how to look at deals and make sure that they actually cash flow and how to set your properties up so that you can run them from anywhere in the world. Like I literally have managed my properties from over 6 different time zones. So if you are stuck in analysis paralysis. You don't know where to start when it comes to real estate investing, but you know that it's something that you want to do in the future. This training is going to be for you. So to check it out, click the link in the show notes or DM me the word hack, like HACK on Instagram, and I will send you the link. Now let's dive back into the show.
So USDA is agricultural loan. Now, what does USDA actually stand for? So USDA stands for the U.S. Department of Agriculture, I'm pretty sure. But it's a zero down payment loan that you can use in certain towns and rural areas. So it's mainly for agricultural areas. But in certain locations, like literally one of my students, Sophia, she bought a house in San Antonio in an up-and-coming area. They had built new constructions and stuff like that, a little bit more on the outskirts. It was considered an agricultural area. So she was able to buy a beautiful brand new construction, single-family home for 0% down. Freaking amazing, okay? Also, the cool thing is USDA loans usually have lower interest rates than conventional mortgages because the government is basically taking the risk when it comes to the lending here. But it's such a great option for anyone who just live in areas that are a little bit more agricultural or like, in downtown Denver, right in the city, The negative part of USDA loans is that you may not be in the most desirable area, but that is all subjective. It depends on what desirable is to you. If desirable is being like further out of the city, then this could be a perfect loan for you. But for folks who are wanting to live like right next to all the bars and restaurants that are popping, probably aren't going to want to use this kind of loan. But it's such a great option for anyone who is more open to living a little bit further out. Okay. Now on to the fourth loan is the VA loan. So now this is for any of my veterans, okay? You guys have the ability to put 0% down on a property, okay? And like all you have to do is actually pay for the VA funding fee, which is about $10,000, but still really great. Now, the positives about the VA loan, also VA standing for Veterans Affairs, no down payment required. You guys also have no PMI, okay? You have lower interest rates and a limited amount of closing costs. So like literally, it's a slam dunk. Anyone who has the ability to use a VA loan and isn't using it, y'all, what are you doing? Okay, what I would do to have that loan, okay? But yeah, such a great option for veterans. The one struggle about it, though, is you do have to be a veteran, right? Like that's the only way that you can actually get and use that loan. There's also the required VA funding fee that I was telling you about before. It's about $10,000. They are a little bit stricter on the appraisal requirements as well. So you have a little bit less wiggle room there. And that just means you have to underwrite your deal better. You have to run your numbers better on your property. But such a great way. And you can use it on single family home, duplex, triplex, fourplex, right? So that USDA loan that we were talking about before, that can only be used on a single family. But for the VA loan can actually be used for multifamily property also. Okay. The fifth loan, we're getting there. We've got two more to go over. The fifth and sixth ones are great. Okay, so the fifth one is the young professional or the physician's loan. Now, this loan is great for anyone who is a doctor, a dentist, sometimes an engineer, right? There are specific loans that are given to young professionals who are a year, a couple of years right out of college, right? Maybe they have student loans. They don't count that against you when buying a property. And you can buy it for 0% down, okay? Low down payment options. This is what we're always looking for. And it excludes student debt from the DTI calculations. And what DTI is your debt to income ratio. So whenever lenders are looking at how much they want to lend you, right, they're going to look at how much debt you have in comparison to how much income you're bringing in. Now, when you're right out of college, right, sometimes you may have a ton of student debt, right? But you're bringing in good income. If you're an engineer, maybe you're bringing in $120,000, $130,000, $150,000 a year. Or a lawyer, you're bringing in $200,000, $250,000 a year, right? Or anything more than that, even as a doctor, things like that. So you can actually leverage these low down payment young professional loans that are specifically for you that have no PMI, that don't take into account your debt so you can buy a property. However, one negative about this is sometimes that they do have slightly higher interest rates because they are giving you all of these other concessions, right? They're not taking into account your debt. So sometimes they'll have a little bit higher interest rates. So you just got to keep that in mind, but still huge. You can buy a property with 0% down, y'all. Yeah, I literally have so many people. I have a lot of doctor friends, lawyer friends, engineering friends who have used this loan. It's great. Okay. And now the last loan, which is one of my favorites. I have a few students who are using this right now, is the NACA loan, 0% down. And if you go back on one of my podcast episodes, I did one with Nancy Rodriguez from Love is Blind, and we really go over the NACA program so much. So go back and listen to that. But y'all, this loan is government funded, 0% down, 0 in closing costs. You literally don't have to pay for anything. Like, they will pay for everything. You can literally show up to the closing table and bring $0 / make money at the closing table. It's such a slam dunk steal of a loan product. There are no upfront costs and fees. There's no down payment. There's no credit score requirements. Below market interest rates. Now, the one thing is you must live in like a NACA area, which is most towns, and there are sometimes purchase limits on these homes. Also, with it being a government program, NACA moves really slow. So you gotta get in there and start the process as soon as possible. Like, literally, I have students who join and we know off the bat that they should go and use NACA. First thing they do is go and attend the meeting, the NACA meeting, so that they can get started on the process, because it just is a lot slower than some of the other loan programs because it is a government funded situation. Okay. So I hope that this was helpful for you. If you're like, I don't know where to start, this is where you need to start. Figuring out what loan you want to use, get pre-approved with your lender, and start putting offers in. Get under contract. There are 62 more days left in the year of 2024, y'all. You can do this. I believe in you. You got this. Okay. Now, if you like this episode, if this was useful, make sure to leave a review on Apple Podcasts. Seriously, this is how my podcast gets pushed out to more people. And this is how I get to help more folks like you get started investing in real estate, quit their jobs, live their dream lives, travel the world, do all the darn things. Okay. I love you, and I'm rooting for you. Thank you so much for listening to Wanderlust Wealth Show. Now, don't forget to follow the podcast, or if you're watching on YouTube, make sure to hit that subscribe button. If you love this episode, it would literally mean the world to me if you shared this with a friend or a family member, or literally anyone off of the street. Right now, go ahead, share it so you don't forget, or post it on social media and make sure to tag me. I love seeing what you're listening in on and what you resonated with, and I'm just so freaking thankful for you. I'm so freaking excited for you. I love you, and don't forget, life really doesn't have to be hard.